So hello everyone. So guys, today we are going to talk about operating cycles. Okay, and we will talk about cash cycle, some other ratios, and some theoretical concept. In the last lecture, what we studied about activity ratios. We talked about like receivable ratios related to receivables, inventory, and the payables. So now we are going to talk about operating cycle. So what is the operating cycle, guys? So here we go. Operating cycle is the time it takes for business to purchase inventory. Then definitely, when we deal in a business, so first generally we purchase the inventory, then we sell it, and then we collect cash from the customer. So actually, the time it takes from the purchase of inventory till the collection of cash from the customer. So that is called operating cycle. So in simple words, if I will tell you here as a timeline, let's assume this is the timeline. Let's assume this is the month of January. And here, this is the point where we let's assume purchase the inventory. Okay. And then, uh, for example, at the end of Feb, okay, we sold the inventory. But let's assume we sold on credit, right? So like on the first day of January, we purchased the inventory, and at the end of February, so here I'm putting January 1st, here I'm putting 28th February. So on 28th Feb, we sold the inventory, and maybe let's say we sold the goods on credit. So now customers are making payment on what? On let's assume March 31. Okay, 31st March, we received the cash from the customer. So this is the point where we collected the cash. Now, operating cycle is what? Operating cycle actually it measures the length or it measures the time that we take, okay, to purchase the inventory, and then we collect the cash from the customer. Like simply from this point till this date. Like here we purchased the inventory and here we collected cash from the customers. So length of the period or the time which we have between these 2 points where we purchased the inventory and where we collected cash from the customer. So that is called what? Your operating cycle. Okay. Now we need to understand when we calculate the operating cycle, how it can work. So simply, if you will look at here, so actually from January 1st till the Feb 28, okay, so almost 2 months, we actually uh, kept the inventory. You can say we stored the inventory. Okay, like these are 2 months, and then from Feb, 28 Feb, it's end of Feb, and then on 31st March, almost 1 month. Okay, we took to collect the cash from the customer. So this is 1 month period. So total how many months we took? 3 months. So these 3 months are your operating cycle. But the inventory holding period, which is from Jan 1st till 28 Jan 1st till 28th February. So these 2 months are called inventory holding period. It has other names also. I told you last time that I'll explain it again. And from the point of sale, this is the point of sale till the collection of cash. So this is called actually receivable collection period. Receivable collection period. Okay. So simply when we add these two periods like inventory holding period plus the receivables or the collection period. So once we will add these two, this duration, once we will add, so this is called your operating cycle. Okay, now let's move to the theoretical concept here. So I have already told you what is operating cycle. It is the time it takes for a business to purchase the inventory, then sell it, and then collect cash from the customer. So this time period is called operating cycle. Actually, what it measures how long it takes to turn goods into cash. This is the main concept. Okay, like almost we took here 3 months to turn goods into cash. So that's your operating cycle. And generally, I have already told you the formula also, just it's a repetition. So once we calculate the operating cycle, this is a formula for that. Operating cycle is equals Days sales outstanding in receivable. Actually, this is collection period. Collection period is also called days sales outstanding in receivables. Plus, we will add here that's called days sales in inventory. This is called inventory holding period. If you will add these two things, collection period plus inventory holding period, so this is your operating cycle. And now, guys, operating cycle. Please remember here for the grocery store, operating cycle could be as short as maybe 2 or 3 weeks, right? For the grocery, like from the purchase of inventory till the collection of cash from the customers, it might be 2 3 days or 2 3 weeks. But if you are dealing with, let's assume, uh, you know aeroplanes, for example, you are manufacturing, you are Boeing company, you are manufacturing, passenger planes. So for them, operating cycle could be a longer, or maybe if you are dealing with the jewelry, so maybe the operating cycle could be the longer period, or it could be the over, it could be over a year, maybe. Okay. Now here we have more detail here. As I told you in operating cycle, so we have two things. We have a inventory holding period. This is the inventory holding period, which is also called days sales in inventory. Okay, it's also called inventory holding period. So actually what it measures, this ratio measures, we discussed last time also, it's a quick revision. It measures the average number of days the company takes to sell its inventory, that how many days we are taking to sell our inventory. That's called it's day sales in inventory. Okay. So in other words, it measures how long inventory sits before being sold. It's the same thing like first line or second line. It's the same interpretation. Now we have second thing in the operating cycle, that is called days sales outstanding in receivables. So this is also called collection period. I told you already, collection period. Okay. So what it measures average number of days it takes to collect cash after sale. That how many days we are taking to collect the cash from the customer. Okay, from the point of sale till the collection of cash. So that is called days sales outstanding in receivables. Okay, it's also called collection period. So in other words, it measures how long customers take to pay. Now, guys, if you remember in the last class, these were the formulas which we have already discussed. Like if you want to calculate a day's sales in inventory, so this is the formula for that. And there are two ways to find out this. Okay, days sales in inventory. So the method one, what is the first method? So the days sales in inventory or the holding period. How you can calculate? You can calculate by taking average inventory. Average inventory, do you remember I told you last time we will take opening inventory or beginning inventory, okay, plus ending inventory or closing inventory, okay, and we will divide with the two. So this inventory generally we have at the start of the period, this inventory we have at the end of the period, and divided by two. So this is the average inventory. So if opening inventory is not given, so please remember ending inventory you can use here instead of average, because average can be calculated if two figures are there. If only one figure is available, you can use that one also. So average inventory is the numerator, divided by cost of goods sold. Okay, cost of goods sold and multiply by 365. So 365 or 360 days in a year. So you have to check the question how many days he is asking you to use. So this is what, so this inventory holding period will give you answer in days. Okay, if you will multiply with 365. If you're multiplying with the 12, so it will give you answer in months. Okay, so there was another formula I told you last time. Okay, that we can calculate same. The holding period can also be calculated by using alternative formula. Alternative formula is what? Before moving to the alternative formula, so first we need to understand the inventory turnover ratio. That I have already explained in the last class. Also, turnover mean to say how many times we sold the inventory in a given period. That's called turnover. How many times? Maybe 30 times, 40 times, 50 times. So what was the formula for inventory turnover? This is the formula for turnover. Okay, if you will remember the formula, if you remember, so the formula was cost of goods sold divided by average inventory. Okay, but here we want to calculate holding period, which is also called days sales in inventory. So this, the first way to calculate the holding period is this formula, average inventory divided by cost of goods sold multiplied by 360 or 365. The second way is what? We can use the turnover answer to calculate the holding period. So this is the first way and this is the second way to calculate the holding period or day sales in inventory. And what's the formula? 365 or 360 divided by inventory turnover. Turnover, like the answer of this ratio, like for example, if it was 50 times, okay, so you will divide it here 50 times. So 360 divided by 50 times, so you will get what? Day sales in inventory. Okay, and either you are using this formula or you are using this formula, it should give you the same answer. Okay, then what second component of the operating cycle is days sales outstanding in receivables. Okay, which is also called collection period. Actually, if you remember, I told you last time, this ratio measures how many days it takes, means that the company takes to collect cash from the customer after making the sale. That how many days we are taking, okay, to collect the cash. That's what days sales outstanding in receivables. Okay, so now there are again two methods, similar like inventory. So the method number one is what? If you want to calculate collection period, so this is how it will be calculated. This is the formula. Okay, average account receivables. Again, average how you will calculate beginning account receivables plus ending account receivable divided by 2. Okay, if beginning figure is not available, so you can use the ending receivables here and no need to calculate the average. So divided by net credit sales. Okay, if net credit sale is not given, you can use a net sale also, because companies might have cash and credit sale both, right? If cash and credit sales both are given, you have to use net credit sales. If there is no difference, or if there is no difference is provided between the cash and credit sale, then net sales figure you can use. Okay, and multiply again 365 or 360. Okay, if you will multiply with 365 or 360, so this will give you answer in days. But if you are multiplying with the months, there are 12 months in the year, so then you will get answer in months. So this is the one way to calculate the average collection period. And second way is what? So second way is this one, alternative way. This is the first way to find out collection period. This is the second way. Second way is what? You can calculate collection period by using this formula also, 365 or 360 divided by receivable turnover. Turnover, again, turnover, how you will calculate? This is the formula for turnover. Okay, turnover mean to say times. Okay, when we attach the turnover word with the receivables, it means how many times we collected the cash from the customer in a given period. So the formula for turnover is what? Net credit sales divided by average accounts receivable. Okay, so again, these two formulas you have to remember for operating cycle, and it depends which formula you will use in the exam question. It depends upon the data availability of data, which data is available. Okay, then, so I hope so this is clear. So we just talked about how to calculate the operating cycle, and for operating cycle, this is the formula. Okay, again, don't forget. Now the question is in exam, which kind of question he will ask? Definitely, if he will ask you to calculate operating cycle, then he will give you data to calculate the collection period and inventory holding period. Okay. Otherwise, other question is what? Maybe he can give you individual question in which you are just required to calculate collection period or receivable turnover, or maybe inventory holding period, or maybe inventory turnover. So any specific individual question can also be tested. Okay, now we are going to talk about operating cycle is clear. And now we are going to talk about cash cycle, which is also called cash conversion cycle. Okay, now again, let me draw the timeline here. For example, let's assume this is the timeline. At this point, 1st January, we purchased inventory on credit. So purchases on credit I'm saying. Okay, credit, like you are buying inventory today, definitely you will pay for the inventory in future. Let's assume you got a credit period of 1 month. So on 31st January, you made a payment for this. You made a payment for this credit purchases. Okay, now what? On 28th Feb, we sold inventory. Okay, and on 31st March, we collected cash from the customer. Now, what is cash cycle? In cash cycle, guys, actually, you will take the difference of these 2 points. This is the point where you made a payment for inventory. Okay, and this is the point where you received the cash from the sale. The difference of these 2 points are called what? Are called cash cycle. Okay, and in operating cycle was the difference of these 2 points. from date of purchase till the collection of cash. That was operating cycle. Now, guys, in cash cycle, so cash cycle is what? It's a difference between, okay, I'll tell you concept later, just I'm telling you first the calculation from calculation point of view. It's a difference between 2 points: the point when you made the payment and the point when you received the cash. So the difference between these 2 points is called what? Cash cycle or cash conversion cycle. Okay, now the question is that how would you calculate it? Okay, a concept I'll explain, just give me a few minutes. So now the question is that how calculation will be done. So please remember, here you already have calculated operating cycle. In operating cycle you took receivable days, which is also called collection period, plus inventory days, which is also called inventory holding period. Okay, now this operating cycle is the difference between these 2 points, from the date of purchase till the collection of cash. Now what? From this operating cycle, if I will deduct this portion, this is called payable days. Payable days in my example, it was 1 month, because you purchased on 1st January, you are making payment on 31st January for those purchases. So if I will deduct the payable days from the operating cycle, okay, so then it will already, it will become what? That it will represent the difference between these 2 points, when you made the payment and when you collected the cash. So this is the formula now for cash cycle. For cash cycle, what you have to calculate? Receivable days plus inventory days, which represents the difference between these 2 points. From there, if I'll deduct this difference, okay, which is payable days, so that is called cash cycle. Okay, cash conversion cycle or cash cycle. Now, here is the concept of cash cycle, what it shows actually. Okay, so cash cycle is also called cash conversion cycle. So actually it is the period when a company's cash is tied up in the business before it gets back from the customer. Actually, guys, look at here, let me tell you what they're trying to tell you. Look at here. At this point, at this point your cash was out, and at this point your cash is in from the customer, right? So now it means this period, this period shows your cash was tied up. Okay, it was stuck into your business. Okay, it was out of your business, but it is still, it needs to be collected from the customer. So this time period, it means you got a shortage of cash. So this is called cash cycle actually. Okay, so this is what they're trying to tell you here. So cash cycle, which is also called conversion cycle, is the period when company's cash is tied up in business before it gets back from the customer. Okay, and here is the simple explanation, key point. So the cash cycle is the actual time the cash is out of company. It was, it was stuck. Okay, it was out of the company, unlike the operating cycle, which does not subtract supplier credit. Yes, in operating cycle, so we took the difference from date of purchase till the collection of cash. Okay, so this is what is cash cycle. Now I have already shown you how you will calculate uh, this cash cycle, and the formula is receivable days plus inventory days minus payable days. Okay, receivable days are also called days sales. Here are the words I have already told you. Receivable days are also called days sales outstanding in receivables or collection period, and inventory days or holding period is also called days sales in inventory. Okay, alternative word you have to remember, guys. Okay, now we already have discussed the ratios about inventory. We already have discussed the ratios about receivables. Now only one more ratio, although I have explained in the last class also. So those that ratio is relevant to the payables that I'm going to explain now. So here, payable, how you will calculate payable days. Payable days are also called days purchases in accounts payable. Okay, it's also called payment period, it's also called payable days, it's also called days purchases in accounts payable. So first way is you will calculate by using this formula. You will take average trade payables. Okay, trade payables means the payables which will arise due to the credit purchases. So average trade payables, how you will calculate? Opening trade payables plus ending trade payables divided by 2, that's your average, and you will divide with the credit purchases. If credit purchases are not given, you can also use cost of goods sold here. Okay, you have to check the question which data is available. First priority is credit purchases. If it's not given, use the cost of goods sold as a denominator and multiply by 365 or 360, whatever number of days are available in a year. So this will give you answer in days. Again, if you want answer in months, multiply with the 12. Okay, this is the first way. There is another way to calculate the payable days or the payment period. Other way is what? This is the formula for, this is the formula. Okay, so formula is, so if you want to calculate the payment period, so the formula is we will take 365 or 360 divided by payable turnover ratio. Now the question is that turnover ratio, how you will calculate. This is the formula for that, to find out the turnover. So turnover, credit purchases or cost of goods sold, whatever is given, so divided by average trade payables. Okay, and turnover, you know, it shows how many times we made payments to our supplier in a given period. Okay, now this is what is the total cash cycle and operating cycle. Now here we got some, you know, key points. So in simple words, operating cycle and cash cycle. Operating cycle, do you remember it was the difference between 2 points from the date of purchase till the date of cash receipts. But I told you in cash cycle, it is a difference of 2 points from the date of payment. Here date of purchase, here date of payment, and date of collection of cash from the customers. Okay, so now look at here operating cycle. It shows how long the business process takes from inventory purchases to cash collection. I already told you. Cash cycle, how long your own money is tied up in the processes. Okay, in the process. I hope it is clear. Now, guys, let's have a look to the question. We got a question here. As I told you, he may ask you to find out operating cycle or any specific ratio. He may ask you to calculate it. So here we go. We got a fact pattern. So question actually data. So a company sells uh, 10,000 skateboards as skateboard a year at 66 each. So if you will multiply units with the selling price, this will give you sales figure for the revenue. Then all sales are on credit. Okay, great. So with terms of 310 net 30. Okay, guys, this is actually credit terms. I have already explained in my previous lecture. 310 net 30 means say what? This is the 3% discount, early settlement discount. If you will pay within 10 days, net 30, because net 30 means say what? Your normal credit period is 30 days. They're saying that, okay, your normal credit period is 30 days, but if you will make payment in 10 days, you will get 3% early settlement discount, which is also called cash discount. Okay, and here in the question itself, they explained that 3 over 10 at 30, what it means? It means there is a 3% discount if payment is made within 10 days. Otherwise, full payment is due at the end of 30 days. Okay, this is what the interpretation they have already provided you in the question itself. One half of the customers are expected to take advantage. One half mean to say one half. Okay, so one half means to say almost 50%. One half. Okay, one half of the customers are expected to take advantage of the discount and pay on date. And they're saying that 50% customers are there who will make the payment in 10 days. Okay, plus then the other half, other 50%, remaining 50% are expected to pay on day 30, so they will pay in 30 days. Okay, guys, now so sales are expected to be uniform throughout the year. Means to say they are saying that it's like a equal sale every month throughout the year for both types of customers. Okay, who are taking discount, who are not taking discount. For them it's throughout the year. Now the question is, what is the expected average collection period? Okay, so average collection period you have to calculate. Now look at here, guys. Just go back and find the receivable formula. Here is the receivables formula. Average collection period. So these two formulas can be used to find out the average collection period. Formula one is this one. You can take average account receivable which are not given, but the credit sales are given into 365. So because this figure is not given, this is given. So we cannot work because one thing is missing. If you will look the second formula, day sales outstanding in receivables, 360 divided receivable turnover. Again, turnover is not available. So now guys, look at here. This is the new uh, another approach to calculate the receivable days. If question is having information about discount, so you will apply this equation. So then receivable collection period will be equal to the number of customers, the percentage of customer who will pay within discount period plus the percentage of customer who will pay, in normal period. So just that average you need to calculate. That's called average collection period, right? So how you will calculate now? 50 times 10, it will be 5 days, plus 50 times 30, it will be 15 days. So 5 plus 15, total collection period is going to be 20 days. Okay, so that's why I just uh, crop this question here, because it's just a new way of calculation. You should understand, like, this is how you can also work if discount period is given. Now we got another question. So answer should be 20 days. Okay, we have already calculated, so D option is the correct. Now another question. We got another question, and see the change in requirements, what they are asking you. Same question we have. Again, we are selling 10,000 skateboards a year at 66 each. This is your sale data actually. All sales are on credit with the terms of 310 net 30. Okay. And they explained that a 3% discount will be given if the payment will be made within 10 days. Otherwise, you will pay in 30 days. And 50% of the customer, 1.5 minutes. So 50% of the customer, they are taking the discount. Okay, and 50% of the customers, they are paying on day 30. Same data. Sales are expected to be uniform throughout the year for the both types of the customers. Okay, now what's the requirement? Changing, there is a change in requirement. Now the question is that assume that average collection period is 25 days. Okay, collection period is already given. Look, he told you if you will pay within 10 days, there is a discount of 3%. If you will pay in normal 30 days, there is 0% discount. And here he told you average collection period is 25 days. So we don't need to adjust this, guys. Okay, like within discount, without discount. Oh, so this 25 days we are assuming, we're using word. So this is like adjusted for discount and without discount customers. Okay, you don't need to do that adjustment. He told you that average collection period is 25 days. Now you should not question this question. You should not, I mean say, you should not have a doubt in this question how they calculated 25 days. This is not our concern. If he has provided you average collection period, that's fine. So after the credit policy is well established, so they're saying that average collection period is now 25 days. Okay, what is expected average account receivable balance? You have to calculate account receivable balance for the company at any point in time, assuming 365 days a day year. Okay, now you have to calculate here average account receivable balance. You have to calculate. So these are the answers. Now which option is correct, that we have to check. Okay, so let me just highlight. So we are calculating average account receivables balance. So how you will calculate this? This is the formula I have already told you. So there is a, guys. This is actually, I didn't tell you. I'm telling you now. That's the reason I have put this question here. So now, guys, the question is how you will calculate. So this formula you can use also if you are provided with the average collection period, which is 25 days. If you know the average collection period, just simply multiply with the daily credit sales. I think so. This I have explained in the last class. So you will multiply with the daily credit sale. So automatically you will get average account receivables. Okay. Now the question is that how you will get the daily credit sale. So daily credit sales we want, right? Daily credit sales. How you will calculate daily credit sales now? So just go back to the question. This is your sales figure. 10,000 skateboards you are selling at 66 each. So 10,000 times 66, because you want average daily sale, and there is a 365 days a year. So 365 you will multiply. This will give you average daily sale. Okay, if you will just calculate average daily sale, you can cross check. It should be this figure. Okay, let me cross check. 10,000 times 66 divided by 365. Yes, so it is 1808.22, and the collection period is 25. So this is the answer for that. Okay, this is the balance, receivable balance. Okay, I hope so it is clear. Now we are talking about, there is another question. Okay, they're saying we have a question: the following inventory and sales data are available for the current year. Okay, and we are using 365-day year when computing ratios. And what we got it here, so we got the information about November 30 year one. This is okay, last year data. This is November 30 year two. This is current year data. And what we got here, we got net credit sales for the current year only, gross receivables we have for the both years, inventory we have for both years, cost of goods sold we have for the current year only. And now what's the question? The question is, you have to calculate a company's average number of days to sell inventory. Actually, inventory holding period you have to calculate. Okay, if you remember holding period formula, just go back and check related to inventory holding period. Here, we have inventory holding period formulas. You can use either this, the first one, okay, this formula, holding period, like average inventory divided by cost of goods sold. And we can use this because inventory data is given, cost of goods sold is also given, and times 365. Okay, so let's go to the question. So formula is average inventory divided by cost of goods sold times 365. Okay, this is your what? Inventory holding period, okay, or day sales in inventory. So now guys, we have here holding period, average inventory. First you calculate, this is the inventory of last year. Okay, beginning inventory I would say 780,000, plus this is the inventory of current year, which is 960,000, divided by 2. This will give you average inventory numerator. Denominator is what? Cost of goods sold. This is the cost of goods sold because you are working for year two only. So year two cost of goods sold is available, which is 4380000, and multiply by 365. Once you will multiply with the 365, what answer you will get? You will get 72.50. The answer will be the correct. I hope so it is clear. Now guys, we got some other ratios also. Okay, uh other activity ratios. Okay, other activity ratios I'm talking about. So the first ratio is fixed asset turnover ratio. Fixed asset turnover ratio. Actually, this what ratio turnover means? Say turnover means, say this ratio will give you answer in times. So fixed asset turnover, this ratio will show how efficiently the company is utilizing its investment in assets. Okay, in assets, but I'm not talking about here all assets. We are talking about here only net property, plant and equipment. Net PPE, property, plant and equipment. And net pp, I hope so you have idea, it's always equals to cost minus what? Accumulated depreciation. That's called net ppe. So here fixed asset turnover, because this ratio is fixed asset. Okay, fixed asset, we are not talking about intangible asset, only tangible fixed assets. So it measures how efficiently the company is deploying its investment in net ppe to generate revenue. Okay, to generate revenue. I'll explain the interpretation, don't worry. So how you will calculate fixed asset turnover ratio? This is the answer. You will take net sales. Net sales we want, not cash sale, not credit sale. Both sales we want net. Okay, divide by average net PPE. Average net PPE, how you will calculate? Opening net PPE plus ending net PPE. This figure will he will tell you in the question. Divide by 2. This is how you can find the average figure. Okay, now for example, the answer is, let's assume 2 times, because turnover will give you answer in times. For example, it is 3 times, 2 times, or 4 times, whatever. I'm assuming it's 3 times. Now you need to understand what is the interpretation of this fixed asset turnover ratio. Interpretation, how you will interpret this 3 times. You can interpret this way. So whatever the investment you have in PPE, whatever the level of investment you have in PPE, so that is generating 3 times more revenue. That is generating 3 times more revenue. Or I can say this way also, if you are comparing $1, so each dollar invested in PPE, each dollar invested in PPE is generating $3 of the sales. So that's another interpretation. Okay. Or you can say this way also, whatever investment you have in assets, PPE, net PPE, so that is generating 3 times sales more than that. Okay. So, or you can say this way also, each dollar invested in PPE is generating $3 of revenue. This is the interpretation. And definitely higher answer is desirable again. Okay, so if answer is higher, it shows that the company is deploying their PPE more effectively, okay, to generate sales. If ratio is lower, it means they're not using assets efficiently. Now we got here another ratio which is called total asset turnover. Now, what is total asset turnover? Total asset means what? Current assets plus non-current assets. So that's your total assets. Okay, so the what's the formula? Total asset turnover. You will take net sales as a numerator again, divided by average total asset. Average total asset, how you will take? Opening total assets, like total asset at the start of period, plus ending total assets, like total asset at the end of the period, divided by 2. This is how you will get the average. Again, now you are trying to check. Okay, for example, if answer is 4 times, now what it shows 4 times, what it means? It means your each dollar invested in total asset is generating $4 of revenue. Or you can say this way also, whatever the level of investment you have in your assets is, that investment is generating 4 times more revenue. Okay. Then guys, this is what is the second ratio we talked about. Okay, about the total asset also. Now I'm going to talk about, there is a some theoretical topic, and this topic is important. You need to understand. So we are talking about now ratio analysis and earning quality, and it's a 3.2 topic in your book. Okay, ratio analysis and earning quality. So what it is? So here we go. First of all, I need concentration. So why, okay, we calculate the ratio. This is the answer for that. What is it for? Like why we are calculating ratios actually. So number one, ratio help us understand a company's financial performance. Definitely when you will calculate the ratio, so you need to compare this ratio first, because ratio in isolation is nothing. Okay, if you have single ratio, answer of single ratio, and you are not comparing with something, you are not comparing with benchmark, so it has no meaning for you. So ratio will become meaningful, okay, or impactful once you will compare with something. So something mean to say what, you can compare with the industry average also. Okay, so you can compare with the similar companies, the average of similar companies. You can also compare the with overall economy. Overall economy means, say, you compare with general economic trends. Maybe you will confuse it, overall economy here, that's why I put it the example. For example, if companies return on asset, this is one ratio, it's return on asset we covered before. If a company's return on asset is 8%, but the average return for all companies in the economy is 6%, like your company is generating 8% return on asset, but average of all companies in the economy in the country is 6%. It means your company is performing better than your economy. That's called overall economy. So you can compare your ratio with the industry average, with the overall economy. You can compare with the single competitor also. For example, Apple Inc is comparing with Samsung. Okay, so they can also compare with the competitor also. Okay, even you can also compare with your own past years. For example, Apple company, now they're sitting in 2025, they have calculated ratio here, so they can compare with the 2024. Okay, to check your ratio has improved or deteriorated. Okay, this is what the is the answer, like why we calculate the ratio, because we want to understand about the company's performance. And company performance cannot be, understood until unless you will compare with something which could be industry average, overall economy, or maybe with competitor, or even with your past you can compare. Now the next part here, who uses ratios? Definitely management will use first, because management, they want to see how the company is doing and make improvements. Okay, or in other words, in which area they are performing well, in which area they are not performing well. So ratio analysis can indicate or highlight those areas also. Then ratios can also be used by investors to decide whether to invest or not. For example, if you're investing into a company, or if you're planning to buy a stock of ABC company, you will check their EPS, dividend yield, etc. Okay, dividend payout ratio, these ratios you will check. Okay, because this will give you confidence that, or this will help you to decide should we invest into that company or not. Okay. Okay, ratios can also be used by creditors, lenders. For example, bank. If a bank wants to lend money to any company, definitely first he will check would this company be able to repay or not. So definitely for that he will check ratios. Okay, then now the next question is why ratios are useful. Okay, why ratios are useful? Definitely, ratios can tell us how efficiently resources are used. Like we can calculate fixed asset turnover, total asset turnover, etc. Okay. Then what? Ratio can also reveal strengths and weakness. Definitely, ratio can also help us to understand in which area we are performing well, in which area we are not performing well. For example, your profitability ratios have dropped maybe as compared to the last year. So then it means you are not performing well. Okay. So it can also help us to make plan for improvements. Definitely the areas where you are weak or your performance is not good, so you can make a plan how to improve those areas. So it can also help us to track progress over time by looking how ratios changes. You can calculate the trend also. Okay, last year what was the ratio, this year what is the ratio, so it can again help us to understand the financial health. Okay, so that's why the ratios are very useful. Now, ratios can also provide extra benefits. For example, sometimes you can compare different divisions. For example, a Toyota car. Toyota, they have, for example, Toyota USA, Toyota Japan. I'm just assuming, guys. So they have two plants. Let's assume. So they will compare, okay, which division, US division or Japan division, which division is performing well. So they can also help for the cross divisional analysis also. Okay. Now, we got here a limitations of ratio analysis. There are some limitations as well. Okay. Okay, so first limitation, please try to understand. There are a couple of points which we need to understand. So the first point is what? Ratios, limitations. I'm talking about problems with the ratios. Limitations mean to say problems with the ratio. So first point is what? So ratios are based on accounting data. Mostly figure you will take either from the balance sheet or from maybe the income statement, at maximum from statement of cash flows also, right? So these are the major sources of data, I would say. Okay, from where we get the information to calculate the ratios. Now it's all accounting data, and now the question is that why accounting data is a problematic. So because accounting data might include lot of estimates. For example, if you will look into the PPE, how it's written, cost minus accumulated depreciation. In accumulated depreciation, it's totally your estimate, because when you calculate the depreciation, for example, if you're applying straight line method, you take the cost of asset, this is depreciation formula, minus residual value divided by life of the asset. So residual value is also estimate that what value you will get at the end of useful life of the asset. Life is also estimate. So that's why they're trying to tell you in accounting data you might also have a provisions, allowances. So all those things are your estimates. So that's why they are trying to tell you. So it is based on accounting data, which is not good, because accounting data can be changed by changing estimates. Okay, so there is another thing they're telling you, because in accounting data we have accounting profit. So here just I want to give you a small idea. Accounting profit versus economic profit, this you will study in future again, but here I'm again telling you, accounting profit is what actually mostly in accounting, whenever we write revenues and expenses, so revenue minus expenses, so these are those expenses for which you have already paid cash or you will pay the cash. For example, maybe you might think depreciation, you would say, oh, it's a non-cash based item, but the depreciation belongs to that asset for which you have already paid the cash. Okay, so that's why in accounting profit, so accounting profit is reported in financial statements, like in income statement, and considers only explicit cost. This is the word now. Explicit cost means those costs for which you have already paid the cash or you will pay cash. So it means explicit cost requires cash outflow. Okay, so that's the accounting profit. But what is the economic profit? Economic profit considers all cost, including implicit. They will have explicits also. All accounting cost plus implicit cost. Implicit cost means opportunity cost. Okay, opportunity cost we don't write in accounting, but we write under management accounting, decision making, but we don't write under financial accounting. Okay, so that is your implicit cost. Now, if I will just make a diagram here. So when we take a revenue, minus explicit cost. So that explicit cost, okay, that's your accounting profit. And from there, once you deduct implicit cost, which is opportunity cost also, so that is your economic profit. So now the problem is accounting ratios are based on accounting profit, not on economic profit. By the way, economic profit is the kind of your real profit, which includes opportunity cost also. That's the problem number one. I have told you it is based on accounting data, which is subject to your estimates. Okay. Then we got another point. Accounting data can also be manipulated by the management also. As I have already given you example. For example, if you will change the depreciation, it will change depreciation expense in the income statement. If you will change the estimate of depreciation, it will change depreciation expense, which will affect your income statement. Definitely it will also affect PPE figure also, because this depreciation will be written as accumulated depreciation in PPE section in the balance sheet. Okay, so that's what is the manipulation. And sometime management, they might have a incentives, performance based incentives. Oh, okay, if profits will reach to this level, they will get 5% bonus. So that's why the management can manipulate the figures again to get that bonus. So this is what they're saying, managers may window dress means a manipulation financial statements to improve ratios due to any reason, maybe due to some incentives, etc. Then there is another point, earning quality. Please remember, guys, earning quality means a what? Okay. Ratios are less meaningful if earnings vary widely year to year. Earning quality means if earning is stable. For example, there is a company who is having a stable or predictable earning. Okay, if earning is stable, we say it's a high quality earning. Okay, but if earnings are volatile, it's changing year to year, so then we say it has low earning quality. So ratios are less meaningful if earnings means the profits vary widely year to year, then ratios will volatile, right? Ratios will also fluctuate. This is what I'm trying to say. So earning quality will also affect. So high earning quality means what? Stable, predictable earnings. This is what high earning quality. And low earning quality means if earning is not able, if you are not able to predict, or if it is not consistent, so that is called low earning quality. Okay. So accounting method, another thing, earning quality will also affect ratios. For stable company, ratios could be different, and for you know for the companies whose earning is not stable, ratios could present completely different picture. Then accounting method also affects earning quality. As I give you example, like uh, if you will change the depreciation method, accounting method I'm talking about, not only estimate, even method, like when you shift from one depreciation method to other. For example, if you previously you were using straight line, now you are going to use double declining method or reducing balance method or sum of years digit method. Every method will give you different figure for depreciation, which will change again what the profit figure again. Let's talk about inventory instead of uh, you know uh, depreciation. Inventory, inventory can be valued under US GAAP. It can be valued by LIFO, by FIFO, average method, etc. Okay, we have a dollar value method. Different methods are there. Every method will give you different figure. Okay, and if figures are different, definitely it means closing inventory figures will change. If closing inventory figures will change, cost of goods sold will change. If cost of goods sold will change, profit will change. And if closing inventories figures are changing, current assets figure will also change, right? This is what they're trying to tell you. So LIFO, FIFO, or any accounting method. Accounting method means wherever you got a choice to apply. Okay, for example, you can apply LIFO, FIFO, that's accounting principle or accounting method. So accounting method will also affect earning quality. Okay. Then next point we got it here. This is LIFO, FIFO, I have already told you. Okay, then we got it here, earning power. Earning power will also affect the ratios. For example, earning power measures firm's ability to generate cash consistently. That's the earning power. Okay, like if you are able to generate cash consistently means say your cash is consistent, not again fluctuating. Okay, that's called earning power. So predictable earnings are essential for paying fixed charges. Look, if you got a company A and you got a company B, here they are getting stable cash flows, and company B is getting, let's assume, volatile cash flows are moving like this. So definitely cash flows will also affect the company. The reason, the stable company with the stable cash flows can pay easily their fixed charges, like interest, lease payments, or even the long term debt, dividend. They can pay all these things very, comfortably. But if the cash flows are volatile again, the company might be in the trouble also, right? So this is what they're trying to tell you here. Sometime earning power, the power to generate cash will also affect the ratio analysis. Okay, the company with stable earning power will have stable ratios, and companies with volatile earning power will have like different ratios in different years, and it will drastically change also. Then inflation effects, yes, inflation can also affect the ratios. For example, ratios can be distorted by inflation. For example, let's assume, I'm just giving example, historical cost accounting may undervalue asset. For example, you bought one land 10 years ago for $50,000, but now its market value is $1 million. If you're using this ratio still on historic cost, okay, and you don't consider the inflation effect, so your here ratio will be different. If you will use this figure, which is closer, which is more about like, let's say market value, the figure will be different. Okay, by the way, in US GAAP revaluation is not allowed, but if in IFRS it is allowed. Historical cost, you can record the assets at historical cost also, or the revaluation model also. But lot of figures, if you're recording at cost, which might not present the true value of the assets, and which can change the ratio if you will use the old figure, or if you will use the latest figure, replacement cost, so figures ratio can change. So this is also the inflation effect. Okay, inflation will also affect the ratio. Then what? Rising interest rates increase debt cost, affecting financial ratios. Yes, if there is a company who got a loan on variable interest rate, so once interest rate will increase, so their loan burden will increase, and it will distort the ratio. And once the if the interest rate is going down, so then it can improve the ratios also. This is another point. Then we got another problems. These all are limitation. I'm telling you, inflation effect we are ignoring. Earning power we need to consider. We need to consider this earning quality also, manipulation by management also. We are using accounting data. All these are limitations, by the way. Okay. Then guys, we got it here. Some comparability issues also. This is also one of the limitation. For example, difference in accounting policies. I have already told you so many times. Like if one company is using FIFO, other is using LIFO, their values, even everything is same. But due to change in method, so their values for inventory will change, cost of goods sold will change, and profit will change. Okay, this is what they're trying to tell you. So this is what they're saying, comparability issue. Like they're saying if company A and B, everything is same, only accounting methods for different item is different. If only counting method, so definitely profit, cost of goods sold, and assets figure will change. Okay, this is what is there saying, comparability issue. So this is also problem. So when you are comparing two companies A with the B, so you make sure they are using same accounting policies. If they are not using, so then even everything is same, just due to change in accounting policies. So this ratio will not be much meaningful because their data is different, their counting methods are different. Then we also need to check seasonal factors. Sometime in, for example, if you're dealing with the ice cream business, so maybe in summer you will have more sale, in winter you will have a less sale. And if you are calculating ratio in summer, result would be different. If you are calculating ratio in winter, result would be different. So this is seasonal effect. Okay, then what? This is just a seasonal effect. Now there is another effect that is called geographical effect. Geographical factors will also affect cost base. For example, there are two companies, company A and B. Company A is in UAE, and definitely here compliance cost is more, labor cost is high. Or company B is in India, for example, their compliance cost could be less, labor could be cheaper also. So now see, even revenue, they are selling same products, even revenues are same, but due to geographical factors like compliance related factors, so their costs are changing, and due to that their profits will change, and you cannot compare it. So geographical factors are also there. Understood, guys? So here I have put it the example. You can just go through that. There is, if the company X is in UAE, if the company Y is in India. Okay, so what will happen in UAE? Labor cost will be higher, strict regulations are there, so compliance cost is higher, high rent is there, high utility cost is there. But in India, labor could be cheaper, less stringent regulations. Okay, so means a low compliance cost, or there could be a lower rent, lower overhead cost, etc. So if both companies generate same sales, A and B, okay, company X or Y, so company X may show lower profits margin due to higher cost, and company Y may show higher profit due to lower cost. So that's why, what's the implication of geographical factor? The implication is that we have, if we compare their profit margin ratio, it may look like comparing Y is performing better because Y companies in India might have low cost structure. Okay, but it's not really fair because cost structure differs by location. So these are the problems with the ratio analysis. Now, guys, I'm going to just show you one more question. You can just get the idea. For example, they are saying that selected data from White Corporation's financial statements for the year ended November 30, year 2. This is the data, or as follows. So, what's the data? The data is we got a current ratio 1.4, quick ratio 0.86, current liabilities, account receivable turnover. I'm highlighting intentionally. Merchandise inventory turnover, it's inventory turnover, highlighting intentionally. Rate of return on assets 6.5%. And here we got now what? Sorry. Here we got account receivables figure 355,000 for year one, merchandise inventory figure 337,000. Now year two operations sales figure is this, cost of goods sold figure is this. So what you have to calculate the approximate number of days in white operating cycle you have to calculate. Operating cycle actually. And if you remember, operating cycle equals, okay, receivable days, which is collection period, plus inventory days. Okay, now I have a question how I would calculate. For receivable days, I told you there are two methods, and second method you can apply. And for inventory days, also second method. So if you will calculate, if you will take 360 or 365 divided by receivable turnover, you will get receivable days. For inventory days, if you will take 360 or 365 divided by inventory turnover, which is given here, that's why I was highlighting. This is a turnover for receivables, which is 3.65 times, and this is the turnover for inventory, which is 3.30. But we need to check how many days in a year. I'm not sure it's given or not. It's not given exactly. So then we have to check how many days in the question is using. But uh, let me see. He is using 365 days a year. So based on assumption, guys, in your exam, he should give you proper, days in a year. If it is not given, so you can use 365, but it should be given. Okay, otherwise it's confusion. So we have to take 365 because they have used 365 in the answer. If I'll use 360, maybe then it will not work. Okay, where is the question? Okay, so we have to take 365. And now if you will solve it, so here if you will solve it, 365 divided by 3.65, it is going to be 100 days plus inventory days. So 365 divided by 3.30, it is going to be 110.6 days. If you will add these two, so your operating cycle is going to be 210.6 days. If you will add these two, okay, so which is correct option? So it will be here, anyone? D option is correct. Okay, guys, so this is what all about unit 3. Unit 3 is over. So next class we'll talk about next topic, corporate finance section we are going to discuss, okay, in the next class. If you have any question, you can ask me, guys. Thank you so much for your time.